Credit rating agency. Hey guys, I welcome you all to DevTech Finance, and here's another video on the topic credit rating agency. So let's get started with this. Starting with the basic introduction. A credit rating agency checks the repayment capacity of the issuer towards principal and interest amount. So what do you actually mean by credit rating agencies? These are the companies that assign certain ratings which rate a debtor's ability to pay back the debt, including the principal as well as the interest amount. So these agencies, what they are doing, they are providing certain ratings on the basis of certain criterias, whether the entities would be able to repay that invested amount or not, whether the debt instrument issued by those corporations are safe to be traded upon, are moderately risky or are highly risky. All these informations would be inculcated by the ratings which is provided by CRAs. So credit rating is required in case of debt instruments only, and these debt instruments could be the government bonds, the corporate bonds, the certificate of deposits, the municipal bonds, the preferred stocks, as well as the collateralized security, which is the securities that are mortgaged by some assets. Okay, so this is what credit rating is actually provided only in the trading of the debt instruments, not the equity instruments and other derivatives. These are only required in the case of debt instruments. When an entity has to issue the debt instruments, it needs to be credit rated, and these ratings provide an overall picture of the credit worthiness of the instrument, which gives an earlier indication to the investors whether to invest in that debt instrument or not. Okay, so the debt instruments, the debt instruments rated by CRAs are all these things, all those bonds and all. The issuer of these obligations or debt instruments may be the companies, the entities, any entity, or it could even be the state or local government. Credit rating is a highly concentrated industry. Why it is a highly concentrated industry? Because there are only few players in that industry. The major players in credit rating controlling approximately 95% of the ratings business at world level are Standard & Poor, Moody's, and Fitch rating. Okay, so these three are the major players at the global level, which together combines approx 95% of the rating business at the world level. S&P, Moody's, and the Fitch rating. Let's move forward and look at some Indian credit rating agencies. These are the CRISIL, the ICRA and CARE. In India, the major players in credit rating agencies are CRISIL, ICRA and CARE, where CRISIL stands for Credit Rating Information Services of India Limited. And this agency was established in the year 1987, headquartered at Gurgaon. Whereas talking about ICRA, it is Investment Information and Credit Rating Agency of India, which was established in the year 1991, headquartered in Mumbai. CARE, this stands for Credit Analysis and Research Limited. It was established in the year 1993, headquartered in Mumbai. Any debt issue of more than 500 crores or maturity more than 18 months have to be credit rated. It is obligatory. If any entity, if any company, or even if the government is planning to issue the debt instruments of worth more than 500 crores, or if the maturity would be of more than 18 months, it have to get credit rated so that it could provide a reliable picture and openness to the investors who are buying those instruments. Okay, so these three were the major players in Indian credit rating agencies, the CRISIL, the ICRA and the CARE. Let's look at some of the ratings, how these ratings are basically provided. So you would see a little bit variation in that, like it could be A plus, B plus, C plus like this also, but a broadly categorized ratings would be this only, where AAA means highest safety and lower risk. AA indicates highly safe and low risk. What is the safety and risk related to? These are related to those debt instruments which the investors would be purchasing, which the entities are issuing. So it shows their level of safety, the level of risk involved, and it is also on the basis of corporation or entity which is issuing that, whether that is capable of repaying, whether that would be capable of repaying the amount invested. Then there is A rating, which ensures adequate safety and a lower risk. Triple B and double B rating ensures moderately safe and involved a moderate risk also. B is lower safety and high risk. It means these debt instruments are not reliable. C is risk prone and D is almost default. So this is on the basis of corporations or the entity's performance, whether the instruments, the debt instruments being issued by those companies, all those companies would be able to repay that investment amount or not. So you should never go with the B, C, D ratings. Only the AAA and AA I would recommend is reliable when you are purchasing any debt instrument. Let's have a look at the process of credit rating. So how this credit rating is done. You know, after analysis being done, this credit rating is provided. So we would see one by one what is the steps. Qualitative analysis regarding the management outlook, background of promoters, educational qualification, and domain knowledge, past credit track record. Okay, so first of all, analysis of the corporation is done. Now, this analysis could be either qualitative or quantitative. Talking about qualitative analysis, it involves the background, the educational qualification, the domain knowledge, and the past credit track record, because this would give a reliable picture of the future, how the corporation is going to do in the future. Second is the quantitative analysis of financial statements like the P&L statement, balance sheet, fund flow, and cash flow. So all these financial statements provide a picture of the business in which the company is inculcated. So this would, whether talking about the P&L statement, the balance sheet, the cash or fund flow, these statements provide an overall picture of efficiency of the business. So what credit rating agencies, the CRAs they check on these financial statements, and they try to analyze these figures of the companies in terms of their profitability, in terms of their liquidity position, their efficiency in doing business, and all those things. Then it holds meeting with entity management and other stakeholders. Then analysis report. The assessment report is prepared on the basis of the financial analysis done, on the basis of the qualitative analysis done. This report is then presented to a committee which comprises senior executives of the concerned CRA. So this report after the analysis is presented to the committee in which the senior executives of CRA is involved. The committee would discuss all the relevant issues and would assign a suitable rating. So after all these steps, what the committee would do, they would discuss all the relevant issues regarding the corporation, its paying ability, its efficiency in doing the business, its past track records, and its future predictions, and then it assign a suitable rating on the basis of that. Let's talk about the international credit rating agencies. Okay, so as I said, there are the three major players which together combines for approximately 95% of the CRA market globally. That is S&P, Moody's Investor Service, and Fitch Ratings Limited. These global CRAs provide credit ratings to countries on the basis of investment opportunities in country. So whether a country is providing good opportunities, whether the country economy is doing well. Yeah, so we are here talking not about the corporations only, we are here talking about the countries. And these these international credit rating agencies, these provide ratings to the countries. They provide ratings to the countries in terms of the investment opportunity on the basis of economic development of the country, whether investing in that country would be reliable or not, whether that country would be able to pay back some returns on your investment or not. It plays an important role in creating sentiments for FIIs who make decisions of investment by considering it as one of the parameter. So, what happens? It creates a kind of sentiment to the FIIs. FIIs are the foreign institutional investors who invest in various countries, and they what is the basis for their investment? They make investment on the basis of the economic development conditions of that country, the investment opportunity in that country. So if the credit rating provided to that country would be lower, these FIIs would not be interested in making any investment in that country. So this is how this global CRAs plays a major role in defining the decisions of FIIs. If you're not clear about FII, what does foreign institutional investors actually mean, you could just refer to one of my video by subscribing to my channel, which is on FDI and FII. There I have talked in details about what foreign institutional investors are and how does they work. So you can refer to that video and you can get an idea about the FIIs. If a country is downgraded by CRA, the risk is related withdrawal of FIIs from stock market. As FIIs depict herd mentality, large amount is withdrawn altogether, which weakens the overall country's economy, impacting negatively. Now let me break down this sentence. What does this actually means? See, if the CRA, if the credit rating agency, the global credit rating agency, if it has downgraded any country, it means if it has provided a poor rating, which right now we have seen the B, C, D, all those ratings. If it has provided to any country, what would happen? The FIIs would feel this country is not investment. Is not providing positive investment. The investments would go in loss over there. So it would result in withdrawals by these FIIs from stock market. And what happens if some of the foreign institutional investors are withdrawing? All others would follow this. So what would happen exactly is that together all the FIIs, as they depict a herd mentality of following one another, a large amount of investment would be withdrawn from the economy, and this would result in weakening of the economy. It would negatively impact on that country's economy. Thus, a good rating provided by CRAs is very important when we talk about the economic perspective of any country. Let's have a look at the criteria for country ratings. So this is first government policies, economic reforms, ease of doing business, fiscal policy framework, current account deficit and GDP growth rate, then the economic attractiveness. So when these world level CRAs, they are providing certain ratings to country, what is the basis, what is the criteria for these ratings? So these criteria are the government policy, the ruling party over there, whether the ruling party is providing some strong indication of the rules, whether the economic reforms in that country is positive or not, what is the ease, what are the certain rules and regulations related to the investments, is there doing business, is the conducting business over there an easy way or not, is it flexible or rigid? Then the fiscal policy framework, the taxes involved, how are those? If the taxes are high, the investment obviously would be a little bit more uh, a little bit more uh, sorry, so the investment would actually be not so attractive. Current account deficit, if the country's balance is going in deficit and the deficit is larger, it would also provide a lower rating to the country, which would impact on the investment opportunities in the country and thus provide a downgraded figure to the global scenario. GDP growth rate, it is one of the key indicators because the growth rate of GDP, it shows how well the country is able to manage its economy, how well it is making development. So if the growth rate is higher, the credit rating provided to these countries would be higher. And on the basis of economic attractiveness, other than that, what is the economic structure of that country, whether the economic structure is attractive enough to be invested upon. So all these all these criteria forms a basis for the rating which is provided by the international credit rating agencies, which were ruled by few of the major players like the S&Ps, the Moody's, as well as the Fitch Ratings Limited. So this was all in this video. I hope you got an idea about what the credit rating agencies are, why does it plays an important role, how does it provides the rating, and what does these ratings indicate. I hope you like this video. Thank you for watching, guys. This is DevTech Finance. Do like and share my videos and subscribe to my channel. Thank you all.